There is one indicator that came out today. It was the University of Michigan inflation expectation, so consumer inflation expectation index. The 5-year was pretty stable at 2.9%. But the 1 year jumped from 3.6%, which is the expectation for the next year, to 4.6%. And I was kind of surprised by that. But as we were talking in our morning meeting, I was saying, what went up a lot in the last month that has the consumer thinking, inflation has taken a surge? And it is gasoline prices. So we did have OPEC telegraph to the world that they were going to cut back production by another 1 million barrels. I think that starts in May. The pricing impact has already started. And yet it is interesting to watch the oil price. If you look at the West Texas Intermediate, it dropped just below $70 and now is back to 80. But it has stopped at 80 regularly this year. And we, in our brainstorm today, we're talking about how much oil demand is being destroyed at the margin by the accelerated shift towards electric vehicles and electric vehicle miles traveled as we see more Uber drivers driving Teslas and other electric vehicles. In China, I believe that 25% of all car sales now are fully electric, compared to closer to 9%, I think it is, in the United States. And now this is going up very rapidly. Commodity prices are determined at the margin, that marginal barrel of consumption. And it seems as though with electric vehicles, we're moving away from fossil fuels. So, I've been saying that we think oil prices have a long way to fall. If you adjust oil prices for inflation, since OPEC quadrupled oil prices in the early 70s, we're already below that level. Now it is adjusting for inflation. And, the lifestyle of people in the Middle East has been upgraded dramatically since that time. And in real terms, the oil price is less than it was in that time. And we think it will continue to fall. So that could be a problem. And, we noticed how, China was able to basically help Saudi Arabia and Iran negotiate some kind of accord. And it's like, what is going on? These sorts of things happen when leaders want to change the topic from what may be going on in their own economies. Maybe, the loss of oil demand impacting the Middle East. Maybe China's recovery post zero COVID policies, maybe not so strong. And we are getting indicators that it is not that strong. Okay, so now, why has the market been hanging on? I mean, all three major benchmarks in the United States, the Dow Jones Industrial Average, S&P 500, and the NASDAQ, all of them are up this year. And in fact, the NASDAQ is up the most, and that's considered the most volatile of the three. And if you look at if you look at the sectors as they're defined by GICS, you'll see they're risk-on sectors that have done very well. Communication services, which includes a lot of the FANGs, up 23%. Tech generally 19%. Consumer discretionary up 13%. That's year to date. And on the losing side of the ledger, financial services minus 4.5%. This is in the S&P index. Utilities minus 2.6 and healthcare minus 1.4. So financial services, yes, have been hit by the crisis. That makes sense. Utilities are coming down because interest rates are coming down. As I'm thinking about it out loud, that should be helping. The dividend yields in utilities have less competition. So that's a curious one. Except that utilities are typically a flight to safety, and the market's not acting like there's a flight to safety.